Is it best to get Social Security at 62, 67, or 70? Here are 8 key considerations. We're going to give you some facts, some break-even points, the pros and cons of each, using some easy-to-read studies, and a Harvard study that shows the good and the bad of working in retirement, as well as what's predicted in the future. So number 1, let's start with this chart on the amount of money you're going to get if you declare Social Security benefits. So if you declare Social Security benefits at any age after 62, but 62 is the earliest and 67 is considered the full retirement age, and 70 is the latest that you should ever file because that's the max amount of benefits. They don't give you any extra. If you wait, you just lose money. So take this calculator from AARP, and it shows the benefits. You start taking money at the age of 62, and that benefit is $1,050, and at age 67, you would make $1,500, which is a 30% increase. So what's the average lifespan? The average lifespan is 78 years old, but don't worry, that number is actually a little bit different. But strangely enough, that's actually the break-even point, which is 78.8 months. They do that because they're factoring the average lifespan. That's not true, because when you hit 65 years old, you're actually going to trend to men 84, women 86. We're going to go through that study in just one second. So the idea of Social Security is they don't want to give away free things. They look at actuarial tables and they base it off that. Now, what if you wanted to wait until you were 70? Well, then you'd get 124% of the full retirement age over when you're 67, which means they give you 8% more a year after the age of 67. And it doesn't matter if you increase the benefits like I did here, because the ratios are exactly the same. I brought it up to 3,000, you'll see it's exactly the same no matter what, it's still the same percentages. So 100% of your benefits are at 67. And you receive 70% at the age of 62 and 124% at the age of 70. That's just a quick summary. And in every case, the break even is exactly the same at 78.8. But the difference is if you start taking money at the age of 70, your break even point is a shade over 80 years old. Now, if you're liking this, make sure you press the like button because it helps YouTube know what to tell others if this could help them as well. Now let's talk about number 2, which is the pros of working later in life. A Harvard article shows the pros of working later from a decreased heart disease, Alzheimer, dementia, and cancer. There's huge health benefits to working later in life. But that same exact article says that if you hate your job, it may actually shorten your life through depression and stress. The point is, you have to feel what is right for you. There's no calculator that can tell you how you feel about your day-to-day living. It's not as easy as saying it could be good or bad. It's your situation, which is why you need a personalized help and attention. My favorite teacher I met later, he actually retired, took the money, and then went back to teaching again. For him, he actually enjoyed teaching. He was too bored, and it actually increased his health and life, and it also increased his Social Security benefit. So if you're uncertain about your health, don't guess. But think about this. If you don't like your job and you're feeling burned out, and you're working a job which is physically grinding and taxing, you may want to retire earlier at the age of 62. So of course I'm saying that maybe there are some benefits to retiring later. Now, number 3, from a monetary perspective, you have to think about life expectancy. And I mentioned this briefly, but the life expectancy is actually 78 when you look at someone from newborn to their death. Average is 78, but what they don't know is that in this Harvard study, if you live to 65 years old, actually, you're probably going to die when you're 84 if you're a male and 86 if you're a woman. Now, really, really important here. That's the averages, which means 50% of those people who are 84 and 86 will live longer than that. So if you're married, there's a 50% chance one of you will make it to 90 and older. I know, my grandma's 94 and she's still going. So think about that. It's not just about the 78 years old, it's about your actuarial tables when you make it to 65. Now, number 4 is important because the longer you can hold off getting Social Security and the bigger benefit that you could receive, it will also increase the benefit for your spouse as well. The spousal benefit increases the longer you wait. That means Social Security can cover more things for more unexpected issues later in life. And another benefit that people don't think about is the more money you get from Social Security benefits, it also means the lower taxes you get. Social Security income actually has preferable tax over anything else. Social Security benefits are taxed lower than any other form of revenue you're going to get. So if you look at your RMDs or any other forms of income, Social Security benefits are taxed the least. Now, there is a double taxation called a provisional tax, and you need to avoid that. But if you look at it, if you look at the entire scale of how provisional taxes are actually formulated, it actually rates Social Security as the biggest thing you should do to help you lower your taxes. Number 5 comes down to how you're planning out your health and how you feel about your work with talking to other people. You need to get feedback on where you are and how you're dealing with your work environment and your health. You need to give an entire full perspective. There's no right answer on how to approach this except for the conversations you have with your doctor and having a good wellness check, as well as talking to your loved ones to know if working has been good for you, because if it has, you may just want to continue based on the conversations of friends and family. Now, number 6 comes from a consideration of doing math with your retirement funds. If you have retirement funds, Social Security benefits go up 6%, 7%, even 8% every single year you wait. You look at the actual scales, they go up higher. It goes up 8% over the age of 67. They start at a little bit shade under 5, then go to 6, 7% as you reach the full retirement age. Now, the S&P has gone up an average of 6.7%. Now, I don't know how well your broker's doing, but if you look at your averages since the year 2000, and that's the key year because that's when they started black box trading and algorithmic trading, which is very important. If you factor in your broker's cost of 1%, the average rate of return is 5.7% over the last 23 years. Now think about that. You're actually going to have a benefit, an increased benefit through Social Security if you're just with an average broker. Now the difference is you don't know where the market's going. You don't. No one has that crystal ball. So that 5.7% I just mentioned to you before, the broker fee, is not guaranteed, whereas those increased benefits to your Social Security are guaranteed. So here's a big thing that you need to understand. Is it better for you to start taking some of your retirement funds before you can actually start receiving Social Security benefits? For some people, it's actually better. Now, there's no great answer to this without going to a financial strategist or a planner and see if those benefits can outweigh the negatives of receiving those benefits and waiting for as long as possible. This way you can guarantee more income for the rest of your life. Having a higher guaranteed income is actually far more stable for you mentally. And the 7th consideration is locking in your benefits because of future changes to Social Security. Social Security has been changing. There has been more means testing and increased taxes. There's no way to avoid this because you're not in charge. In 1984, they started taxing Social Security benefits on a federal level. And in 1993, they actually increased those taxes on Social Security benefits. They've increased things like IRMAA on your Medicare because the government cannot take the strain of having more people into the system without having the necessary funds. So they're playing financial shenanigans. Look at this. In 2034, as it stands today, the Social Security Benefit Trust actually runs out. Now, is that actually what's going to do? No, it's not going to run out. Don't panic. It just means that they're probably going to create more inflation. That's probably what they're going to do. Now, I'm going to give you an example about a friend of mine who's actually in the military, and they offer him to retire with full benefits. Now, he was thinking about working longer, increasing his salary, therefore increasing his retirement package. But there were rumors they were going to cut pensions in the future for soldiers, and he realized it's better for him to lock in his benefits at the highest rate that's guaranteed today and lower those risk factors tomorrow. Something you should know. That does not mean to panic. Usually legislation like this takes a long time, and if you follow the news, you'll know if it's coming. This way you can act appropriately. So here's the trivia question for this video. Could you imagine a date and time in which they start doing further means testing for Social Security for future benefits, as well as increasing tax rates and tax tables to make it harder for people who have more money to receive Social Security? Comment down below, because they've already changed it. They've already changed full retirement age from 65 to 67. So I think the answer is yes, but I want to hear what you have to say because no one has a crystal ball. And the 8th one's actually a little bit fun. It's what I consider a delayed hybrid retirement. Hybrid retirement you may have heard of. It just means you're working and receiving Social Security benefits. But what you don't know is maybe you want to retire when you're younger, take your benefits, and then stop when you're 65, 67, because you can, and then go back to work. Now, so you actually have a lot of flexibility here. You can receive your Social Security benefits and work part-time or full-time, or what you can do is that you can actually enjoy retirement when you're younger and your body's healthier and then go back to work later. Now, I know there is age bias when it comes to hiring people, but if you are happy working some kind of job, either at Home Depot, Lowe's, or Walmart just to cover bills, and maybe what you want to do is just enjoy your retirement when you're younger, that is just based on what is best for you. So you can actually pause your benefits when you go back to work and let them reaccumulate. It's really up to you. There's a lot of flexibility that people just don't know about. Now, there is a myth that when you go back to work and they start taking some money out of Social Security benefits that you lose that money. That's not true. What that means is that when you're under the full retirement age of 67 and you earn $2, you lose one benefit if you go over the cap, which is over $21,000. And then once you start working over the age of the full retirement age, for every $3 you earn, you lose $1 in benefit. Now, you don't lose that money, and what happens is it just goes back into your account and it keeps accumulating with the increased cost of living adjustments. So it actually comes back to you with bonuses. So look, Social Security was never made to be a sole means for retirement. It never was meant to be that. It was meant to be supplemental to pensions, which is pretty much dried up. But if you want to see how to create an optimal retirement based on guaranteed income, watch this video over here because it'll explain exactly what I consider the optimal retirement plan.